My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Who are these people who keep saying stocks are too expensive? If they're so pricey, why the heck do we keep seeing such large takeovers that Wall Street adores, at least judging by the action in the stock price of the acquirer? When the buyer's shares go higher, that tells you the market approves of the deal. It's one of the main reasons why all three major averages had record closes today. Dow gaining 191 points, S&P jumping 0.75%, NASDAQ 0.32%. Sometimes these deals make so much sense that you got to wonder why they took so darn long. Why an online discount broker, Robinhood, eliminated commissions on trading. Well, they're going to make their money on credit balances, meaning your assets. That forced the rest of the industry to follow suit. And because the others made a lot of money from commissions, their stocks were clogged. But Charles Schwab, with $3.8 trillion in assets under management, took advantage of the sad state of the industry, swooping in to buy competitor TD Ameritrade for the relatively low price of $26 billion. And voila, now they have $5 trillion under their belts.
House of pleasure.
I remember a time when Goldman Sachs debated buying little Charles Schwab. Look out, $78 billion Goldman. Schwab's less than $20 billion from you, and it's now gaining on you. Although I have to wonder if Schwab doesn't really have, at this point, a better business model for the future, particularly for those millennials, than Goldman right now. Unless the Apple credit card turns out to be huge, Goldman has some real catching up to do. It could double its assets under management and still not come close to the new Schwab. Lots of critics sneered when they saw how much LVMH, the parent of Louis Vuitton and Moet Hennessy, had to pay for Tiffany, $16 billion or $135 a share, given that the stock was at $90 a little over a month ago. But if that was such a bad deal, why has LVMH stock roared higher? Tiffany's had some pretty darn horrible numbers worldwide. I think they simply didn't understand the new retail world that's defined by personalization and high touch. For years, the jewelry chain has missed numbers, frequently blaming the strong dollar, which hurts tourism. At one time, they even blamed Trump for lower traffic after the election. I mean, who knows? They always had something. But you know what? You take something like the riots in Hong Kong. That should hurt companies. It hurt Estee Lauder. You see them complain? No, they sell a ton of expensive cosmetics in Hong Kong. They didn't use an excuse. They may have hurt sales, but Estee Lauder is such a well-run business worldwide that it didn't matter. So it's not just that if you're in the premium category, like Estee, like Tiffany, come on. One does well, the other one doesn't. Both EL and then LVMH understand high touch. The need to maintain a close connection to your customers. Now, Tiffany's going to learn that, too. I am sure LVMH gets it because this company's been a marquee account for Salesforce.com. You know, they were lauded at Dreamforce last week by Mark Benioff before this deal. He's the co-CEO and founder. The salespeople seem to know everything about you when you shop at one of their stores. Tiffany, on the other hand, they seem to draw a blank when you walk in. When you're shelling out a lot of money for high-end jewelry, you want the people who work there to recognize you, remember your preferences, suggest ideas. I bet their numbers will soar after this takeover closes. Soar! Even in takeovers where the target has surged higher, the acquired stocks are rewarded. Novartis, NVS. It snapped up medicines company for $9.7 billion this weekend. They're paying a price that's 340% higher than where medicines was at the beginning of the year. And what happens? The Novartis stock actually rallies a bit. Why? Because they're buying a twice-a-year injection that lowers your cholesterol. The current standard of care requires you to get 2 shots a month. Fits in perfectly with Novartis' considerable heart franchise. I think the lower the cholesterol, we're going to find out, fewer the heart attacks, the more that Novartis is going to look like a genius for buying this. All right, now, if acquirers are being rewarded for snapping up other companies, that tells me that these stocks may be a lot cheaper than you think, and many stocks may be cheaper. And once you start seeing this kind of action, other businesses are encouraged to make deals too. So you can expect more mergers going forward. It's axiomatic, people. It will happen. What industries are likely to have more activity? First, yes, is retail. We have way too many stores in this country. You hear it over and over again. We've seen a major bifurcation in the industry with haves thriving and the have-nots falling apart. Now, that doesn't mean losers like Kohl's, Gap, or Macy's will get bids. They're cheap and profitable. Look, my Chapel Trust owns Kohl's. Okay, I'm dumb. But I don't know if anyone can figure out how to reverse their fortunes. But there are some underperforming chains that represent attractive opportunities here. I cannot believe how cheap Foot Locker is right now, even though it had terrific same-store sales. I know the Nordstrom brothers do not want to sell, but that quarter wasn't even given the respect it deserves. See, as the company now is the thriving business online and off-price, and that's what you know I care about. Oh, by the way, don't you give up on Bed Bath & Beyond. Not with that new management. No way. Second, there are way too many software companies in cybersecurity, call center, data mining. Splunk just reported a fantastic quarter. Stock's up again today. It could be a consolidator. Should New Relic, CyberArk, Fortinet, CrowdStrike, FireEye, Zendesk, RingCentral, how can I help you? Five9, all be independent? I don't think so. Oh, and here goes Palo Alto slouching back towards Bethlehem here with a big run after big run because of a weaker than expected quarter. Sorry, that random Joan Didion, but I loved her. Okay, third, there are tons of high-quality biotechs out there with stocks that should be much higher. I mean, how does BioMarin really? We had just JB on me last week. How does that, with a solid business and an amazing pipeline, how does that stay independent? Hey, listen, if Biogen's Alzheimer's drug is as promising as it seems, then it's worth a lot more than its current $54 billion valuation. Look at how well AbbVie and Bristol Myers have done since their biotech deals. More on Bristol Myers later, and I still regard some of Allergan as biotech. Fourth, we have about 1,000 more banks than we need. Oh, maybe 2,000. I know a lot of that's because the regulators don't want to let any of the big dogs become even larger than they are. But banks with terrific technology can deliver spectacular results if they buy banks with inferior tech. Fifth, same goes for financial tech. Now, we have too many payments companies. If Square can't get its stock price moving again, hey, what a natural, right? Six, nothing needs more consolidation in the online food delivery business. I think Uber would explode higher if it sold Uber Eats to Grubhub. And it would pay off for Grubhub, too. Certainly, it's better than the current strategy. Or, strategy, put the quote marks there. Seventh, semiconductor mergers tend to be problematic because most of them need Chinese approval. If NVIDIA is ever allowed to finish buying Mellanox, that could take up the numbers dramatically. What did I tell you about NVIDIA? It's up again today. What did I tell you? You saw Jensen Huang last week. How brilliant is that man? By the way, everyone offline says, well, there's Jensen and then there's everybody else. You say that about Bezos. If China, they still do. If China's willing to play ball, it would make a ton of sense for NXP Semi, Qorvo, Skyworks. I don't know, maybe they all come together. Boy, that would be fabulous. These potential mergers don't all have the beautiful synergy of Schwab Ameritrade, where the combined company can cut its ad budget, reduce its tech spending, and lay off an immense number of people. Not good for people who work there, but great for the shareholders. They don't necessarily have the elegance of marrying LVMH's sophisticated tech and touch with Tiffany's brand name. You don't always get a whole new drug pipeline for $9 billion like the Martis did with Medicines Company. But my point stands. Bottom line, some companies may be too big to be acquired, but there are thousands that aren't. And after today, I'm tired of hearing how expensive these stocks are. If they were so darn expensive, we wouldn't be seeing all of these deals. Despite all the grumbling about overvaluation, I think it is a very, 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 very good sign. Maria in Michigan. Maria!
Tim, Maria from Detroit here. I wanted to get your take on eBay. I've had eBay for a few years now, and with the StubHub selling off StubHub, I want to know what I should do with it.
Yeah, you want to hold on. I mean, it's going to be a slow grind. There isn't a lot of growth that I like. I prefer PayPal, which is the other part of it. But it will work its way higher. I actually think that's okay. It'll work its way higher, as I see some stocks working their way higher while I'm doing the show, including this Ameritrade. What a deal that was for shareholders. How about Matt in Texas? Matt.
Hey, booyah, Master Cramer-san.
Booyah.
I'm a retired boomer, and I've been in the markets about 30 years or so, and I'm still a grasshopper next to you. I'd love to take some profits from the younger generation, though. So I'm talking about a stock, RVLV. Revolve.
Okay, I think
I bought
it's the
50
future.
shares at 35, and I averaged it down to 100 shares to 28. And it's possible I'm in a position to where I could average 200 down to 23.
I would do it. It's an e-commerce fashion company. It fell out of favor. A lot of these companies that weren't making a lot of money or losing money, but these guys are okay. They're going to make 50 cents. I think it's a buy. I think it's actually turning right here too. I would buy now. Let's go to Tom in New York. Tom.
Hey, booyah, Cramer.
Booyah.
I've got a CD coming due pretty soon, and I want to invest in some gold bullion. What's the best place to buy it at spot?
Okay, well, I'm going to give you my sense on gold, just so you know, is that I like the GLD. Historically, I have said that people who buy gold keep it in a deposit box. A lot of times, it's better keep it in a deposit box in another country, too, by the way, just for pure security. Because remember, it is an insurance program. That's how I view it, and you can't be insured well enough. All right, after today, I am tired. I am tired of hearing that stocks are too expensive. These deals are a very, very good sign. And yes, if the market goes down tomorrow and you want to tweet me and yell at me, here's what I have to say. I like Tesla. I like Tesla. On Man Money tonight, with news that Bristol Myers has completed its acquisition of Celsius, what should your next move be? I'm talking with the CEO. Then PVH just reported after the close. In the midst of a global trade conflict, can the stock stay in fashion on the Wall Street runway? And get this, I've got the exclusive with former DuPont CEO Ellen Coleman taking the reins of a 3D printing startup worth over $2.5 billion. Wow. Hey, by the way, I'll also get the outgoing CEO. Who's staying on? Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.